Hey, y'all, welcome back to Random Gleanings. I am Chris. He is Jesse. Jesse, it's January 2025.
Hard to believe.
It is. What do you see for the beginning of the year here?
Well, I don't have any crystal ball, so rather than start by looking forward, let's take a second and just kind of look back at where what's gotten us here.
Yep.
How about that? This first chart you pulled came from, I guess, is a more graphic representation of some research that Data Trek, who we've referenced in the past, did, and it's pretty alarming to me.
It's alarming to me, too. I mean, look, I keep reading things. Oh, it's not just 7 stocks. Look, at the end of the day, we're going to show you that the markets have been more narrow. And dang it, it's not a real comforting feeling to know that 7 stocks generated 16% of the S&P's return last year. And so, for us...
And more than 20 the year before. So it's been a continuation of these monster stocks. And God, I mean, that's awesome for those guys. They are phenomenal businesses, but it's
very narrow.
Unless you've piled into those names at pretty high valuations, you haven't... maybe recognized all of what's been out there.
And look, I'm not saying anything's going to go wrong, but it could.
Right, it could.
It could. Yeah. And if you don't think stocks will react quickly to that, they will.
Yeah.
And so the big question is now, I mean, obviously there's a ton of AI investment. Everyone is now listening very closely to conference calls to see if Amazon or Microsoft or Meta sort of tip their hand to spending less with NVIDIA, which hadn't happened.
Hasn't happened to this point. That's right.
But at some point, it just got to keep your eye on it. Anyway, it's important to know that absent those 7 stocks would have been up 6% last year.
Yeah, or diversification probably away from just the S&P 500 didn't result in the numbers that the S&P put up.
Right.
So
that's right. This next chart that you have shows the compound annual growth rate for the last 10 years of the S&P.
Yeah, it's hard to see up there in the left-hand corner, but that number they've got at 13.5 effectively over the last 10 years, and a total return over that time frame of about 255%.
And so the return for the S&P 500, including dividends, since 1928 is like 11%.
No, since 28, it's been about 8%. Okay. Now, if we go into more modern times, I think since 1980, it's closer to 10-ish%.
I'm looking at the number since 1983. It's 11.2%.
Oh, there you go.
Somewhere in that neck of the woods. So, I mean, in more recent times, it's been closer to 11. But 13 is above, and I pulled the 8-year number this morning, and it's like 15.6. So, I mean, those numbers are modestly elevated.
Well, and the 255 number to me is not unheard of for a 10-year time span, not at all. In fact, there's been better 10-year spans than that. But there's not been a whole lot better 10-year spans than that. And so it's getting out, as you think of a bell curve, it's getting out to that kind of right end of things where you would expect maybe just to see some normalization. Maybe we don't have 13% returns moving forward on an annual basis.
Right. So we'll talk about what might bring that in a second, but let's take a look at what's happening internally right now. So this is a chart from our friend Willie Delwich at High Mount Research, and this is a chart of the global stock market, the All Countries World Index, or ACWI. And what this chart is telling you is, in orange, it's roughly 35 to 40% of global markets are above their 10-month average, which is sort of a generally accepted, smoothed out way of looking at it. So you would like to, I mean, any chart you look at, you'd like to see it above its 10-month moving average if you've got money in it. If you're below it, it's generally not something that's like super warm fuzzy of I'm convicted about this investment for the future.
There are trading disciplines that say if it's below its 200-day moving average, you don't own it. Right. And if it is above, then you own it.
And so 60% of global markets are below their 200-day moving average. That's not particularly strong.
Right. That's correct. Now, there would be some criticism in that America or the U.S. has dominated global markets over the last 12, 15 years. And so if we look and turn only to domestic markets, you've got this chart that breaks it down by sectors. Help explain this.
Yeah, there are 11 sectors in the S&P 500. This is a chart again from Willie. And what you'll see is that anytime you have sort of that middling area in white, 2 to 8 sectors above that 200-day moving average, stock returns aren't very good.
Yeah, I mean, that's a surprising thing. And we've looked at this before, but you can see as you look at, the year of effectively what 2022 was, it's in that kind of no man's land, those sectors are. By the end of 22, it's down to zero of the sectors were, and that's when things kind of took off again, right? So, it's just surprising that things work out this way. But to your point, we find ourselves in a range that he would say, or his research has pointed to not being, exciting as it pertains to future returns in the near term.
That's right. Kind of in no man's land. Right. So when you're in no man's land, the average returns from 1989 to 2024 were negative 2.6%.
Right.
When you're above 8 sectors participating or below 2 sectors participating, returns have been 13.6%.
Pretty wild.
I mean, it's pretty simple.
Yep.
Okay, so moving on, though, looking at where people are right now, December 2024, people own 70% on average of their portfolio in equities versus a long-run average since 1988 of like 62%.
Yeah, I mean, that's more than a 10%, or really about 15% above their normal or their average holding in stocks. And, while it is not predictive, you can see that, folks were up around that 65, 66% in 2020, and then they dumped stocks because of COVID, right? You can go back to 2007 and folks were up there, elevated percentages, and the market crashed and people dumped their stocks. So it's as much a behavioral recognition, I think, from my perspective as to what we're looking at. But, as things get overweight to stocks,
that's typically when the rug gets pulled.
that CD holders are saying, I got to get into the stock market, right? And that has some anecdotal evidence associated with it.
So let's look at the next chart. And this is a chart of the 2-year, and we're getting ready to share, I'm getting ready to share what I believe is probably the largest risk to stocks at the moment. So you've got the 2-year U.S. Treasury yield and the Fed funds rate, and they're basically sitting right on top of each other. And the inference here would be, hey, the Fed needs to quit cutting rates. Like when those two meet, that's telling you, okay, that's enough.
Yeah, I mean, you can see from late October until I guess around March of 23. Late October of 21 through March of 23, the 2-year yield was below.
Yeah.
Right. And
which was implying the Fed needs to start cutting rates. And now where we are is they're equal, right? Which would imply, okay, the Fed is, based on the data we have today, in the correct spot in terms of just being a cool customer, not lowering rates anymore, not necessarily raising rates anymore at this point.
Hang tight right now.
Just hang tight,
yeah.
Right?
Yeah.
The big risk, in at least my opinion, is the uninversion of the yield curve. And we talked about this a few months ago, but now we're at a point where, we all know that if we put money away for longer, like, going with a parent to the bank, looking at CDs, I mean, you're supposed to get more on a 1-year CD than you do on a 3-month CD. You're supposed to get more interest, right? Mm-hmm. Well, the yield curve was upside down for so long where, from a bond perspective, you got more near term and less from a long-term perspective just because the Fed had raised rates so quickly. Now you're at a point where it's uninverting, and now things are normalizing, right? But it's just like the mortgage rates side of things that we talked about a few months ago as well. The 10-year is going to affect things in the economy. It's going to affect higher mortgages, which would affect a higher 10-year would affect a higher mortgage, which might affect the real estate market, right? Mm-hmm. likewise, a higher 10-year would also affect what people are willing to pay for stocks, and that could affect the price of stocks also. So this chart that we have on screen, the yellow line represents 0, where the curve is just flat between a 10-year and a 3-month bond. You can see it was negative down to negative 2% back in 2022. Now it's positive again. The long run average is 1.1%. But if we put a measurement on the chart and looked at where kind of a sweet spot would be historically, going back from like 1990 until now, it would be around 2.2% higher. That would imply, I don't think we're going to get to that point, but I mean, if you've got a 4.3 90-day treasury, it would imply that the 10-year could go to 5.4. It's currently at what, 4.6? 4.6, 4.7. It could go to 5.4. That would be the long run average. No one should be surprised by that.
No one should be surprised. But to your point, that probably re-rates stocks a little bit.
It would re-rate stocks.
So
there's no question.
Yeah.
And at the moment, one question we're getting asked a lot is, how does the new administration affect things? Well, you know, if you do things that cause a lack of labor supply, then you potentially also have some inflationary type stuff to pop back in. I know we're all tired of that word, but it's still there, and it's still an issue. The counter to that, and I know our friend Warren Pies has talked about this. I mean, if you had a growth scare, that might cause markets to sort of snap back in shape. That would be negative for stocks too, but it would be more positive from a rates perspective. Anyway, say all that to say, it's not that anything's broken. Stocks are a little bit elevated. Probably the biggest risk in the near run is interest rates. Where do interest rates go, and where do stocks kind of reprice as a result?
That's right. That's right. Well, you have a good holiday season, good kickoff to the new year.
Fantastic. Very good. Ready to go for 2025. Still watching Landman. Heck of a show. How about you?
Yeah, same, much the same. We got a family gift of a ping pong table, so there have been some pretty epic battles in my garage over a ping pong net. So it's been a lot of fun.
Nice. Good.
Fun. So, well, friends, thank you so much for watching. Happy New Year to you all. We look forward to sharing thoughts along the way in 2025. And check out our new channel as well, Retirement Ready, where you get some practical advice on financial planning for yourself into the future. Thanks.